Welcome to the Deep Dive. Today, we're looking at something pretty interesting from Warren Buffett, arguably one of the world's most successful investors.
Yeah, it's fascinating. He actually points to his first big move with Berkshire Hathaway, the textile business, as his absolute worst investment.
Which is kind of stunning when you think about it. Berkshire Hathaway is Buffett. So in this deep dive, we want to really get into that 1965 acquisition.
Exactly. What went wrong? Why did it happen? And crucially, what can we all learn from it? Because there are some big lessons here about investing, about business strategy.
For sure. Now, Berkshire today, it's this huge conglomerate, but it didn't start that way.
Not at all. Its roots go way back, 19th century, to Massachusetts cotton mills.
Berkshire Fine Spinning Associates and Hathaway Manufacturing.
Right. They merged in 1955. But by the time Buffett enters the picture in the mid-60s, well, it was a big name in New England textiles, yeah, but it was really struggling.
Facing huge headwinds, right?
Yeah. Oh, massive. Cheaper imports flooding the market. The whole U.S. textile industry was, frankly, in decline. It wasn't a growth story.
And the company itself was shrinking.
Definitely. Between, let's see, 48 and 65, they'd closed factories, laid off workers. It was clear things were tough.
So how did Buffett get involved? He started buying shares in '62.
Yeah, around then. He noticed this pattern. When Berkshire closed the mill, the company would often buy back shares, and the stock price reacted. So he started buying for his investment partnership.
Buffett Partnership Ltd.
That's the one, picking up shares for about $7.50, give or take.
And his goal wasn't initially to run a textile company.
No, not at all. The idea, it seems, was more opportunistic. Maybe there'd be a tender offer if they liquidated more assets, and he could sell his shares for a neat profit.
Yeah.
A quick turnaround.
A classic value play almost, looking for that catalyst.
Sort of. And it nearly worked out that way. In 1964, he actually had a verbal agreement with the guy running Berkshire then, Seabury Stanton. The agreement was for Berkshire to buy back Buffett's shares at $11.50 each.
Sounds like a decent profit, almost 50% up from his average buy-in.
Looked that way. But then the official written offer came through, and the price was just slightly lower, $11.375 per share.
Wait, how much lower is that? Like 12.5 cents?
Exactly, a tiny difference. But that small change, it apparently infuriated Buffett.
Really? Over 12 cents?
That's the story. He felt, slighted, maybe double-crossed, and instead of just taking the slightly lower price or even haggling,
He changed tack completely.
he decided, right, I'm not selling, I'm buying more, enough to take control of the whole company, and fire Stanton.
Wow. So he did it.
He did. By 1965, he had control. But now the average price his partnership paid was up to $14.86 per share.
So much higher than his initial buys and way higher than the buyback offer he turned down.
Yep. And interestingly, even at that price, you could argue it looked cheap on paper. Berkshire's net operating capital per share, basically its working capital, was around $19. Forget the value of the actual mills and machines.
So he bought it for less than its working capital, around 76% of book value, I think.
That's right. So on the surface, maybe still looked like a cigar butt investment, one last puff of value left. But his strategy had shifted dramatically from a quick flip to taking the helm of this struggling ship.
Okay, let's break down the mistakes. Buffett himself calls it his worst deal. What exactly went wrong, based on what we know?
Well, the biggest one, arguably, mistake number one, investing in a declining industry.
He knew it was bad.
Oh, yeah. The sources say he knew the textile business had, quote, no future. U.S. manufacturing was facing intense global competition, especially from places with way lower labor costs. Berkshire couldn't really compete effectively long-term.
He had that analogy, right? The kitchen cockroach.
That's the one. You fix one problem in a really bad business, and another one just pops up immediately. It's relentless.
And the track record before he even took over showed it.
Absolutely. Billions in sales over the previous 9 years, but they'd lost $10 million overall. That tells you something. It just flew in the face of investing in businesses with, strong competitive advantages, durable moats.
Okay, so bad industry. What was mistake number two?
That's the opportunity cost. Huge. All the capital, all the effort poured into trying to fix the unfixable textile business.
Could have been somewhere else.
Exactly. Especially in insurance, which Buffett was already getting into. He himself estimated years later that if he'd just put that initial Berkshire money directly into insurance instead, Berkshire Hathaway, the company, might have been worth twice as much by around 2010.
Twice as much? How much are we talking?
The estimate was something like an extra $200 billion. Billion dollars with a B.
Wow. That's a staggering opportunity cost. It really hammers home that point. A bad investment doesn't just lose you money, it prevents you from making money elsewhere.
Precisely. It highlights why cutting losses, even if it hurts the ego, and moving capital to better uses is so, so critical.
Okay, bad industry, massive opportunity cost. You mentioned a third mistake earlier linked to that takeover decision.
Right. Number 3, emotional decision-making.
That reaction to the lower offer.
Yeah. The sources are pretty clear that feeling angry, feeling cheated over that tiny price difference was a major driver in his decision to take control. It wasn't purely a rational analysis of the textile business's prospects.
Emotion trumped logic.
It seems like it, which is a huge red flag in investing, right? Letting anger or ego dictate multi-million-dollar decisions is usually a recipe for trouble.
A very human mistake, but a costly one. Was there a fourth key error?
I'd say the fourth ties into the ongoing struggle, the continuous challenges, and the constant need for capital investment.
It didn't magically get better after he took over.
Far from it. The textile business basically limped along, mostly unprofitable, for another 20 years before they finally shut it down in 1985.
20 years.
Yeah. And management tried. They really did. But it just wasn't a good business. It faced this constant dilemma. Do you pour huge amounts of money into modernizing plants, knowing the returns will probably be awful because the whole industry is just hyper-competitive? Or you don't invest, and your equipment gets older, less efficient, and you become even less competitive. It was a classic capital trap. Even projects that looked okay on paper, based on standard ROI analysis, just didn't pan out because the industry dynamics were so brutal.
A no-win situation, basically, recognizing when the whole game is rigged against you.
Exactly. Sometimes the headwinds are just too strong.
Okay, those are some clear mistakes. Now, why? Why did someone like Buffett fall into these traps? What were the underlying reasons?
Well, digging into the sources, a few things stand out. First, that initial focus was purely on short-term gains.
The liquidation play we talked about.
Sure. He wasn't thinking about the long-term health of the textile industry because his plan was just to get in, wait for a catalyst like a plant closure and buyback, and get out with a profit.
So that short-term focus might have blinded him a bit to the really deep long-term problems.
Could well have done. He wasn't analyzing it as a long-term hold initially. Second, maybe an underestimation of just how bad the industry decline was.
He knew it was bad, but maybe not that bad.
Possibly. He saw the challenges, clearly, but maybe didn't fully appreciate how relentless the pressure from foreign competition would be, or how long the downturn would last. Maybe he hoped for some kind of stabilization, or that they could carve out a niche. It's easy to underestimate those big macro trends sometimes.
True. And then the third reason, we keep coming back to it.
The emotional reaction. That really seems to be the pivot point. The anger over the Stanton offer, that feeling of being slighted seems to have overridden his logical plan. Sell the shares and push him into Plan B, hostile takeover.
It's such a stark example of emotion clouding judgment.
It really is. And finally, there's potentially the sunk cost fallacy and maybe a simple reluctance to admit a mistake.
Meaning, once he was in deep, taking control, put more money in.
It becomes harder psychologically to just say, okay, this was a bad idea, let's cut our losses. You've invested time, money, ego. You want to make it work.
That feeling of, I've already put so much in, I can't stop now.
Exactly. That's the sunk cost trap. It might have kept him pouring resources into the textile business for longer than a purely rational analysis would have recommended.
Okay, so we've got the mistakes and the likely reasons behind them. Let's crystallize the lessons. What should investors and business leaders really take away from this whole episode?
Lesson number 1, and it's a big one. Thorough industry analysis is absolutely crucial. Don't just look at the stock price or the asset values.
You need to understand the business environment.
Deeply. Is the industry growing or shrinking? What's the competition like? Are there sustainable advantages? Buffett learned he should have focused more on the no future aspect he initially saw. Buying cheap assets in a terrible industry is usually a trap. Low prices often exist for a very good reason.
So lesson 1, dig deep into the industry itself. What's lesson 2?
Avoid emotional investing. Easier said than done, I know, but vital.
Keep a cool head.
Absolutely. Decisions driven by anger, fear, greed, or even ego, like Buffett's reaction to the Stanton offer, often lead to poor outcomes. Stick to your rational analysis, your predetermined strategy. Don't let pride or frustration make your financial decisions for you.
Lesson 2, stay rational. Number 3.
Recognize and cut your losses early. This is tough, but so important.
Admit when you're wrong.
Yes, and act on it. Don't hang on to a losing investment just hoping it will turn around, or because you don't want to admit the mistake. Buffett himself said he held on to the textile operations too long. The sooner you cut a loser, the sooner you can redeploy that capital into something better. It's about pragmatism, not pride.
Cut losses, move on. Makes sense. And the final key lesson.
Perhaps the most transformative lesson for Buffett himself. Invest in good businesses, not just cheap stocks.
This was a big shift for him, wasn't it? Influenced by Charlie Munger.
Hugely influenced. He moved from looking for fair companies at a wonderful price, like maybe Berkshire Textile seemed initially, to seeking wonderful companies at a fair price.
Quality over just cheapness.
Exactly. Focus on companies with strong fundamentals, good management, and, critically, a durable competitive advantage and economic moat. The textile business had none of that. A great business can overcome hurdles and compound value over time, even if you don't buy it at the absolute bottom dollar. A bad business will just keep demanding capital and disappointing you.
That shift really defined his later success.
It really did. It's probably the key lesson learned from the textile mistake.
So it's incredible, isn't it? He calls it his worst investment, and yet...
And yet, Berkshire Hathaway, the company born from that mistake, became the vehicle for one of the greatest investment track records in history. It's quite the paradox.
It shows that even a bad start doesn't have to be the end of the story.
Not if you adapt. Buffett didn't just stick stubbornly with textiles. He used the cash flow it generated, however small, plus funds from his partnership, to buy into much better businesses.
Insurance, primarily. National Indemnity, Geico.
And later sees Candies, Coca-Cola, American Express. He skillfully pivoted, reallocating capital away from the dying textile mill, which he eventually shut in '85, towards these fantastic businesses.
And the rest, as they say, is history. The growth in Berkshire's value has been phenomenal.
It truly demonstrates the power of learning from mistakes, being flexible, and having the strategic vision to redeploy assets effectively. A bad investment can become a foundation for success if you manage it right.
So summing up the big takeaways. Analyze the industry deeply, keep emotions out of it, cut your losses when you're wrong, and focus on buying quality businesses.
Those are the core lessons from this deep dive into Buffett's worst investment. And they're timeless, really. Studying successes is great, but sometimes you learn even more from the mistakes, especially when they're acknowledged by someone like Buffett.
Absolutely. So here's something to leave you with. Think about a time maybe you held on to something, a project, an investment, an idea for too long. Looking back, what were the fundamental flaws you might have overlooked? And what role did your own emotions, maybe pride or hope, play in keeping you there? Reflecting on that might just reveal some valuable lessons for your next decision. Thanks for joining us on The Deep Dive.